Hi, it's Lena with Sensible Portfolios. While investing is simple, it is certainly not easy. Today we're going to cover common mistakes that investors make so you can learn to avoid them. A major culprit killing investment returns isn't what you'd expect, and that's because it's the thing you have the most control over, your emotions. Don't let fear or greed inform your decision making. Remember that most of your investment returns are driven by your asset allocation, not by timing the market's ups and market downs. Nobody can predict the future, and nobody can outguess and outperform the market over the long run. Instead, keep your eye on the bigger picture. You'll be rewarded if you can stay the course. Fees and expenses, like returns, compound over time. They have a negative compounding effect that often eliminates the magic of compounding returns. Smart investors avoid expensive investment products and look for cheaper alternatives. Did you know investment products have an annual fee called an expense ratio? Think of it as the investment's operating expenses. Some investments have a high expense ratio while others have low expense ratios. Beware of investments with high expense ratios as it materially reduces your long-term results. Paying an extra 1% annual fee over 30 years can reduce the ending value of your investment by 30%. Index funds and other passively managed products usually have very low expense ratios. These are great investment options. You'll earn more while paying less. Smart investors take advantage of a concept called diversification. This is where you spread your investments across different asset classes and geographies to reduce your risk and smooth out their performance. With a diversified portfolio, some of your investments do well while others don't. Diversification will smooth out those returns, benefiting you in the long run. You've heard the expression before, don't put all your eggs in one basket. And that's exactly what diversification helps with. It puts your eggs in multiple baskets. So, in summary, if you're able to manage and control your emotions, avoid high management fees, and have a diversified portfolio, you will be handsomely rewarded in the future. Thank you again for watching today. We'll see you next time when we kick off our next learning module on savings and debt.